what you'll take out at the end of today is a new perspective on why. Why is the unicorn strategy apparently the only game in town? Why is it that so many of these good endeavors end up in washing? Why is it that only 1 in 10 startups really succeeds, even though so many of them look as if they really ought to succeed when you look at the business plan? So I'm going to start with this version. This is a very, very simple fund composed of 10 companies, and all those 10 companies do is invest money in a volatile market and get some level of interest gain or loss on their investment. So if I just have a quick look at one of the companies in here, and I look briefly at the inputs, the only input in here is that there's an initial investment of $10,000, and that the money in the bank account is growing on a month-by-month basis, an average of 1.34% growth per month. That's the average calculated. The worst month is minus 30%. The best month is 32.68%. So it's a very, very simple example of what we're talking about. Pure capital growth or loss, average 1.34%, minus 30% the minimum month, the worst month, plus 32.68 the best month. And let's have a quick look at the projection. This is standard modern portfolio theory, or sorry, standard business planning first. So the standard business plan says, as you would imagine, after 10 years, you've had a nice steady growth of 1.34% per month. The net value of this investment vehicle at the end of 10 years is 49,000 euros, based on an initial investment of 50,000. So you've had a 5x growth, which isn't too shabby over a 10-year period. And this is what normal planning tells you. And normal planning tells you from this is a pretty good investment. If you're comfortable with a 5x growth after 10 years, go ahead and put your money in this. This is safe. However, if we look at this company, not averaging first to get the 1.34% per month and then compounding over 10 years, but instead looking at what might actually happen on a typical sequence of month after month compound growth. So in this stage, we can look at 500 equally likely single paths on a month-by-month basis. That's what you see here. And if you compare the two, this one, path one, you're netting out at minus 33,000. If you look over here, volatility tax, non-ergodic losses, this is your deficit or gain versus the standard projection. And so that says path one, when you actually correctly model the volatility on a month-by-month basis, not averaging first, but actually looking at one likely sequence of random events month to month, you're 33, nearly 34,000 euros down on the original plan. Go to a second equally likely path. Well, you're insolvent in month 42. You're at maximum non-ergodic losses. 3, same. 4, insolvent month 35. 5, there you've got a 6,500 euro gain versus the standard plan. And if we keep going on all of these equally likely paths, what you see is that the vast majority of them in this particular setup, around 1 in 20 of them, there you had one that actually went way over. Around 1 in 20 do around this prediction or better. The other 19 out of 20 do significantly worse. And you can look at all 499 runs in the fan chart, and what you see here, the blue line is your middle likely outcome. So your likely outcomes after 10 years, half of them are worse than the blue line, half of them are better. 10% you're hitting insolvency very early on. The next 15%, which is the lighter blue band, you're still hitting insolvency within 5 years. The next 50%, which is the lightest blue band in the middle, they're still going insolvent or close to insolvent by 10 years. And the only ones that actually do as good or better than the original prediction of classic planning approaches is the upper part of this dark blue band. In other words, you need to hit it lucky. About 1 in 20 does the job. If I now look at the entire portfolio of 10 companies that all have this behavior, but completely different month-by-month fluctuations, if I look at the portfolio prediction using standard portfolio planning, and this is what modern portfolio planning is based on. It's based on taking the average growth rate of each company and the average sigma of each company and then extrapolating that forward over the time period. Again, you see here, this says the total fund value at the end of 10 years is going to be healthy. It's going to have grown 5x. When I repeat it now for the entire fund of 10 different companies with exposed to different sequences of randomness, you get again the single path. And again, I can move through all of the single paths, and you can have a look here at the number for the volatility deficit of each path. In other words, how much are you losing in a typical outcome versus what planning tools tell us to expect? And what is your likelihood of hitting the 3x target? And again, you'll see as I go through this, so that one actually not too bad, and that one we did pretty well. That one, no, 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 no. Well, that one, now this is an interesting one. This shows you one of the, let's say, misperceptions that we get suckered into in the investment world. Keep in mind that what you're seeing here is pure randomness. This is the isolated effect of volatility, of unknowability. And we might have interpreted over here that the investment team is doing a really good job and people might have put more money in. And then we might interpret this and attribute it to some loss of quality in the team. We might blame somebody, we might fire somebody, but there's actually no difference in the team. There's no difference between this curve and that one, which goes way down, and that one. All we're seeing here is just the pure impact of randomness without any, let's say, it's a pure play for the randomness. Everything else around quality of the management team, the staff, etc., is factored out of this. And again here, if I go up to the entire spread, again, we see with this portfolio exactly the same outcome that we saw with the individual companies. You have only about a 10% chance with this portfolio after 10 years of being at or better than the prediction that modern portfolio theory would give you, and a 90% chance of doing worse, and a pretty high chance of losing all your money. Now I can jump back and just show you something different. Remember that what you've seen here is pure capital growth. We can do the same thing with a fund of 65 different companies, and each of the companies has revenue streams, cost streams, and money that they have in the bank. They can generate revenue from, at least they can generate interest from that. Just showing you what happens here. It takes a bit of time for it to chunk through the entire simulation. So this is a standard portfolio of 65 different companies. And what you're about to see is the standard prediction that you would get from, say, modern portfolio theory. What you're seeing here is 3 investment rounds, an initial founding round, a pre-seed round, and a seed round, and another round, which makes 4 rounds. 3 rounds. And then you see here the growth from the revenue as the revenue growth kicks in. And you see here downward the initial expenses in setup costs of starting up the company. What you're also then about to see is this is the entire fund of 65 companies. This is one of the typical paths that the portfolio might go down. And you see here, you have a volatility tax, or in other words, non-ergodic losses that are, well, almost your entire predicted fund benefit here. You've significant losses. Move to another equally likely outcome. That one's doing a bit better. Not so good. Worse. Still losses. That one is better than the normal prediction, but notice it came in at random right at the end. It wasn't looking so hot over here. Not good. That looked really good, and then randomness kicked in and it dropped down to a loss. Not good, not good, not good, not good, not good. So again, what you're seeing here is these non-ergodic losses, the losses versus standard prediction technology, when you actually include correctly the impact of volatility, they're significant. And if I jump to all 500 plots on the same graph, what you see is that you only have a 37% chance of hitting your 3x or above target. You do have some probability of exceeding that, but overall, even a portfolio of this size is not doing as big it's not having as big an impact as you would ideally hope. Now, in a moment, I'll show you what you can do in a portfolio to correct that. And then I will open space for some discussions and questions. What you're seeing here are the 65 different equally likely outcomes for your 500 equally likely outcomes for your portfolio of 65 companies, where the 65 companies have no connection with each other. They have no relationship with each other at all. If, however, you think of these instead of as 65 companies in a diversified portfolio, you think of them as 65 companies in some kind of holding company structure where you can set up a systemic connectivity between them. That's what this ergodicity correction is doing. In this simple example, it means that the 65 companies begin to function a little bit like, say, 65 different brands in a Procter and Gamble, where they have some level of collaboration between each other as well as competition, and they can do things like pooling resources. So if I take the ergodicity correction up, note right now, the volatility tax, the non-ergodic losses, which is based on this middle blue line here, is minus 436 million versus the prediction of modern portfolio theory. So let's see how those losses change if we increase the ergodicity correction up to, let's say, 55%. Takes a moment to trundle through calculating all 65 portfolio companies over a 10-year period, and then 500 different possibilities for all of them. So what you're seeing here now is that the volatility tax has dropped by about 40% versus where it was. You're doing significantly better. Your likelihood of hitting the 3x target has jumped to 64%. And if I increase the ergodicity correction to 100%, you're going to get a little bit of an improvement. Let's see how much comes out. So this has now dropped to about a 60% improvement, and we're now up to a 73% chance of hitting 3x or greater. So with the ergodicity correction in, this is actually a good idea to invest. If we switch the ergodicity correction off, in other words, we go back to the standard approach to investing in 65 completely different companies, diversified, yes, we have all of the benefits of diversification, but none of the benefits of coupling between the companies. We now have an ergodicity tax of minus 440 million. So, and only a 36% likelihood of hitting the 3x minimum return on investment that the LPs are expecting this portfolio fund to generate. Right. So at the moment, what we've built in is the simplest possible ergodicity correction, which is that each of the companies in the portfolio, if they make a profit in a given month, 10% of their profit goes into a central pool and is immediately distributed out to all 65 companies again in an equal ratio. And what that does is it just balances out the impact of randomness. If we had a big enough set of companies and we were running at 100% correction, you would end up coming back to the predictions of modern portfolio theory. And that's, in a sense, the key, the myth inside modern portfolio theory is that randomness averages out, and that you can average it out first and then extrapolate over time. What we're showing is that to actually hit the predictions of modern portfolio theory, you have to average out the randomness every month, not just, you have to average it out for real. And if you think of systemic investing, this is one of the things that we're saying needs to be at the heart of systemic investing, is to set up the system of companies that you're investing in a way where you can create a powerful coupling between the companies so that they truly function as a system in the same way that a forest functions as a natural, complex, adaptive system, where if one tree in the forest is having a little bit of a shortage of water, the role of the soil, the mycelium, the aquifers, plays the role of redistributing resources across the entire forest so that the whole forest stays strong and nothing in the forest dies just because it got unlucky. The beauty of this is there are a huge number of examples all over the world. Uh, One of my favorite examples, I used to work for Procter and Gamble. If you, Procter and Gamble is a company with 65 different brands, 22 of them generate $1 billion or more per year. And you can think of Procter and Gamble through this lens as a top level holding company, like a private equity firm that owns all 65 independent companies and does a 100% pooling mechanism between them. That gives you the same outcome as P&G as it is now, where you have the top level listed company, all of the different brands run on a budget, but the top level P&L is one single P&L. All of the money goes into the top level P&L and then gets distributed via budget. So P&G is an example, and all of the big conglomerates are actually really good examples of this systemic approach. On the other hand, if you go to Asia, if you look at the Japanese Keiretsu, the Korean Chaebol, if you look at how China operates with specific cities that are focused on, and there's the Chinese toy city that makes something like 65% of the world's toys. You know, they also work this way. When I was living in China, we had three suppliers in Guangzhou. And at first, head office in Cincinnati thought that they were competing with each other. And yes, they were competing vigorously with each other to land the job with P&G. And then they were collaborating at the highest possible level with each other to deliver the job in the best way possible. And so again, they had this highly competitive, highly collaborative relationship. If you look in Africa, you find this way of working is part of the African tradition. The traders in an informal marketplace, they might be competing with each other for an individual customer's money, but then at the end of the week, they'll come together and pool resources so that one of them can go off and buy a motorbike or whatever is needed. So I will pause at that point. I can keep talking about this for hours. The three primary drivers of this volatility tax or the ergodicity deficit, one of them is anything where you have multiplicative growth always has this deficit. And there's a huge amount in business that has multiplicative growth. Secondly, anything where there is a possibility of insolvency. Again, that is always going to bring in an ergodicity deficit. And thirdly, anything where there is a resource constraint at the upper limit. So the three primary factors is you have an insolvency lower limit, a resource constraint upper limit, or multiplicative growth. And what you've been seeing here, the ones that you were seeing for the investment company, that was, and actually the normal revenue-based portfolio as well, it was the multiplicative growth source of volatility tax that kicks in first and takes everything down into, or many things down into insolvency. And with some of the possibilities, you saw it flattening off at the top. That's where it starts to hit into resource constraints. And if you hit a resource constraint, then sooner or later, multiplicative growth is going to take you down towards insolvency. And I can also point you at my book, which dives into that in detail and has all of the gory maths equations in it as well. Um, the The only situation where you don't have this ergodicity tax is if you have purely additive growth and no possibility of insolvency or resource constraints. Then you will get out of the correct calculation of the individual volatility. You'll get the same outcome out of that correct calculation that you do out of a standard business plan theory or portfolio. So, impact for investors. The the biggest necessity for this ergodicity correction to minimize the losses due to these non-ergodic dynamics, in other words, minimize the ergodicity deficit, the biggest requirement is that the companies that you're investing in behave countercyclically. That for every event in the world that some set of companies lose from, there's another set of companies that benefits from. In this sense, you get very little benefit from the ergodicity correction, let's say, if you're only investing in fintech, because if something hits the fintech industry, all of them are going to go down. One of my favorite examples of, or two of my favorite examples of where this ergodicity correction works really well. We're running on Zoom. When COVID arrived, Zoom took off massively, not because Zoom did anything special, but because it was the right kind of company when everybody was forced to start working remotely, whether they wanted to or not. Another company that went very, very close to insolvency was the German unicorn Get Your Guide, which provides individualized travel services. And they came close to bankruptcy. Now, if those two companies had been together as an ecosystem of companies, when COVID hit, the ecosystem as a whole would have been buffered against what was happening with COVID. And that means that when COVID ended, the ecosystem as a whole would have been ready to take off much better. Whereas separated, Get Your Guide was not ready to be able to take off properly. Zoom had problems then of overcapacity and also ran into potential issues. My other favorite example from the COVID era, if you look at companies like Unilever or Procter and Gamble, some of their products collapsed for a couple of years, like Procter and Gamble, male grooming, shaving, that the revenue from shaving almost disappeared. But all that P&G did was shift people onto things like mouthwash, because mouthwash was proven to kill COVID, and shift some of the production lines over to manufacturing alcoholic hand gel. So if you look at P&G's share price through the COVID period, you barely notice COVID. Whereas if you look at independent single companies like Zoom or Get Your Guide, you see COVID massively. The greater the diversity, the higher the number of possible combinations, the greater the chance for any given event that what's detrimental for one company will be beneficial for another company, and they keep swapping as time passes, and the black swan, white swan events and randomness change. And that there's, well, I think this is a situation where bigger is better. The the bigger the diversity that you're investing in, the bigger the number of companies, the more chance you have that at least one of them will thrive. So picking up on both of your questions, the first one is what we need to retain from modern portfolio theory is the message that the more you have diversified, the greater your chance of getting the return that you're after for a given level of risk. What's missing in portfolio theory, though, is first of all the correct calculation of the impact of randomness. That's what portfolio gets wrong. So we're saying at the very least, before you take any investment decision, get an estimate of the impact of randomness. In other words, what is this ergodicity deficit? Because that's what you should take your investment decision on, not the prediction that modern portfolio gives from the MPT equations. And then what we're saying is, assuming that you have enough diversity, the minimum that you ought to do is set up some level of profit pooling mechanism between the companies. Now, an example of this that is about 100 years old is the Mondragon group in Spain, where they now have around 80,000 employees, about 250 separate companies within the Mondragon group. And so each of those companies is invested in by the group, and they pool. Each of the companies puts somewhere between 14 and 40% of their profit into the central pooling mechanism, which is used to maintain the health of the group as a whole. And that led, for example, in the 2008 crash, Mondragon did not add one single person to the unemployment statistics, even though Spain as a whole, the unemployment statistics went very high. So part of what we're seeing is that doing this profit pooling process, doing the ergodicity correction, is at its easiest if you have a large number of diverse companies that are still completely independent companies at one level, but they're all part of a larger holding company or group structure where there's an ecosystem level governance that can maintain the trust at the level of the entire ecosystem. There's no risk that one of the companies that is getting lucky will be pulled out of the ecosystem for short-term extractive benefits, and diversity, well, and independence of the individual companies. So for the investment fund we're working towards building, our approach is to set up a holding company that will be the primary investor in all of the different companies in the system that we invest in. That gives us full ability to optimize the spaces between the companies as well. If we see, we have a company here and a company here, but the whole would become much more systemic and anti-fragile if there was another company over here, then we are fully empowered to create that company to fill in the gaps. If I flip this around, the same is true for net present value calculations. In an NPV calculation, we typically take an average rate, an average interest rate, and we extrapolate that average back over 10 years. What we ought to do is model the month-by-month fluctuation of the interest, unless it's a fixed interest payment. And then you see that the NPV calculation is the most likely outcome is worse than what a normal NPV calculation gives. You have the ergodicity deficit. Julia is busy about to publish a paper pretty much on this, applying an understanding from energy network theory, which is from living systems, to the circular economy, and showing very clearly, yes, this is exactly analogous to a living system where you need to have enough complexity, enough diversity, and enough competition for the living system to be viable. It's exactly putting those patterns into practice. And nature has been successful for 4.7 billion years because it has understood the volatility tax and understood how to correct for it. So really all we're doing with this methodology is showing mathematically why it works. And yes, the Quaxala approach, from conversations with Pete, all of the indigenous traditions, they know this intuitively. And so anybody who's following the indigenous patterns will be doing this. As I put it, indigenous communities that didn't learn how nature actually worked in times of volatility died out. And so what we're seeing now is the survivors, the people who learned to work with nature as it actually is. There's the understanding of how randomness actually impacts growth, which is the reason why. But the crux of then minimizing the negative consequences of randomness is to have mechanisms that really create systemic relationships between all of your investments, where you have a container, as you say, a container that can, the primary role of the container is to create systemic trust across all of the members of the ecosystem and between the ecosystem as a whole and all of the investors. When you're calculating an individual company's business plan or calculating a portfolio, and yeah, yes, I agree with you, not many people use modern portfolio theory as is, but almost all of the versions first do an averaging over volatility and then extrapolate forwards an average growth rate. And that's mathematically strictly overestimating the most likely outcome at the future point in time. So the first message is really you do need to look at the probability distribution of your volatility and do a Monte Carlo simulation of 500, maybe 5,000 of the equally likely paths in the future to get a good idea of what is a typical outcome, which is mathematically strictly lower than the average outcome. Yeah. If you want to go off and play with this, you're more than welcome to. It's at planner.evolutesix.com. I alert you at this point, it's not that easy to play with because there are a number of factors that have not yet been built out to the point where the user interface is easy and intuitive. This is still very much something that does the job with the engine, but not yet made fully easy to use. If you do hop on and decide to play with it, the two examples that I'm going to show you today, those are in here in the templates library, and you can just import the template into your working area and then play with them as much as you wish.